Hey everybody, it's Justin here. Just me today. Roman and Leo weren't able to make today's video. But today would have been episode number 15 of the Whiteboard series, but I'm going to be rebranding the video series from the Whiteboard series to Bulletproof Coffee and a Talk. So when I do these conversations, I'll have my Bulletproof coffee here and we'll just talk about something pertaining to financial planning, investments, just like we always have with the Whiteboard series. But wanted to try and change the setup a little bit more, make it a little bit more comfortable. Still going to try to keep these videos, with the exception of today because I have this explanation, between 3 and 5 minutes. So real short bursts of information for you, the things I think are important for you to understand when it comes to financial planning, investments, anything that may pertain to your finances. So today's 15th/first video of Bulletproof Coffee and a Talk is going to be about a term that I heard this week quite often called mean reversion. And the reason this came up in conversation and on TV was there was a hit piece out this week from the Wall Street Journal about Morningstar. If you're not familiar with Morningstar, it is a company that tries to rank mutual funds, gives you a place to do research on funds and stocks, but they have a very famous star rating for mutual funds. And it ranges from 1 to 5 stars, obviously 1 being weak, 5 being the strongest. And the article kind of talked about how the star system can be a little misleading, that not all 5-star funds always do well, and kind of attacked what Morningstar was trying to do. I don't think it was necessarily a fair approach. I think that advisors using Morningstar in their research, which I don't do, but if you are an advisor using it, you should know that the 5-star or the star rating is looking at past performance, and every piece of literature you ever receive when it comes to investments talks about past performance is not indicative of what the future performance may be. I think what Morningstar is trying to do is kind of give a universal way to kind of judge how funds have done as a starting point for your research and then go forward. But I digress. So that is why mean reversion came up. I heard a conversation and people were talking about how the 5-star funds end up becoming 3-star funds and 2-star funds, and they talked about mean reversion. For those of us in the industry, we all know what mean reversion is, but if you're not, you may not be familiar. So we're going to go back to middle school math, if not middle, definitely high school math. You remember mean, mode, and median. So the mean is the average, the mode is the most frequent number in a series of numbers, and the median is the middle. So the reverting to the mean just simply means coming back to the average. And how does that impact your portfolio? What does that play when it comes to investing? Well, we know that historically the average for the U.S. stock market is around 7%. So that would be the mean. And a reversion to the mean, reverting to the mean, you hear it both ways, just means that it's going to, at some point, the U.S. market would come back to average out at 7%. Now, as you know with most averages, whether it's looking at grades in classes or just averages in general, we very rarely spend any time at the average. We're either above it or below it. And those above and belows combined together, divided by the number of periods, gives us our average. So very rarely does the U.S. market or any investment perform at its mean or its average. So if we're spending time up above the mean, eventually we're going to have to revert back to it. And in order to revert back to it, that means our performance and growth will need to slow down to bring us back to the average. On the flip side, if we've been underperforming, then we need to outperform to bring our performance back up to the average. So reversion to the mean just means if we've been doing real well, we may want to reset our expectations that things may slow down because we're going to come back to that average. And if we've been doing poorly, then we may see some outperformance to bring us back to that average again. So why is it important for you to know this? Well, one, as we continue this long bull market that we're experiencing, you're probably going to hear reversion to the mean come up more often, just meaning we're going to see a correction, we're going to have a slower growth period in the future. So you're going to hear that term. So at least knowing what they're talking about when you hear mean reversion in conversation or read about it. Secondly, it's important to know that if we're going to be kind of using these metrics with portfolios, it might be realistic to reevaluate portfolio expectations. Now, not trying to guess when these reversions are going to happen or when these corrections might happen, or even try to guess what's going to happen in the future, but if we're relying on a certain rate of growth in your financial planning, and this is a conversation to have with your financial advisor as far as what are the expectations. If expectations are continuing to be high returns and we're coming out of an extended period of high returns where we may expect low returns in the future, do you need to revamp your planning and make adjustments in case that does happen? So use the reversion to the mean conversation as a way to reevaluate what your expectations are for your portfolio. Most advisors are doing this, but it's a way that you should use mean reversion in your conversations with your advisor. And then finally, the reason we need to do that is this: knowing that the market's investments are going to come back to their average should help you realize that it's okay when the markets slow down. It's okay when the market's correct. That's normal. Mean reversion is a normal part of the process. And why that is that important? Well, it helps you, I hope, stick to your investment philosophy and stick to your investment policy statement rather than try to chase, rather than panic when things correct. So know that that's part of it. We're always going to come back to that mean, so don't overreact. And finally, I guess I said finally already, but another final reason is that I think reversion to the mean gives another strong argument for the value of being diversified and rebalancing regularly, so that we are not trying to guess when the reversions are going to occur, what market's going to outperform, which market's going to underperform. Just have it all across the board, in line with your risk tolerance. Rebalance regularly, so if you're having an outperformance area, you're taking from that outperforming and putting it into the area underperforming, because remember, outperform will eventually come down, underperform will eventually come up, so you're moving from the high, which might go low, putting it into the low that might go high. Key thing to remember, we never know when this is going to happen. My buddy Brendan Mullally did a great piece on this. I'm actually going to have a link to it below the video. If you're watching this on YouTube, head over to allaboutyourbenjamins.com. Underneath the video on the blog post, there'll be a link to Brendan's piece. But it was all about mean reversion, how we never know when it's going to happen, and how it can sometimes be mean. So in closing, to try to keep this video shorter with my little lead-in, just remember that mean reversion means that we're going to be coming back to what the historical averages are. Averages are just that, they're the average. We're usually above and below, and in order to come back to what usually is the smooth ride, the average amount, we're going to have to make adjustments with our expectations. So mean reversion just means coming back to the average. It's a normal part of investing. It's something we have to deal with, and just understand that and know that. So that is the conversation on mean reversion. I'm going to finish my Bulletproof coffee. So hopefully next time I'll have the boys here with me, and we may even have an announcement of the third little guy being here. We'll probably just flash a picture. I'm not going to bring a newborn and put him on the video. Feel free to reach out and let me know if there's any topics that you would like to have me discuss. Always looking for new ideas. Otherwise, I'll just keep on pulling from what I'm hearing in the news and try to make it so you guys know what's going on. So I'll see you in the next one.